The definition of divergence, the most common definitions that we use to define divergence is, on one side we have negative divergence, a situation when the price hits new highs and the indicator or the indicators show minor highs. So it's a bearish alert. And a positive divergence, a situation when the price reaches new lows and the indicator prints higher lows, so unconfirming the price action. So it's, in that case, a positive divergence is also a bullish alert. It's important also when we consider confirmation and divergence, that one of the basic principles of technical analysis is the assumption that a trend is in place or still operative until we have enough evidence that a reversal pattern has been formed and completed. Okay, we always expect a trend to continue. This is one of the basic tenets in technical analysis, and although very basic in itself, very simply, it's sometimes forgotten when we feel the impetus to fade the trend, to enter against the trend. It's useful to think that one of the basic principles in technical analysis, the existence of technical analysis in itself, is because price is trend, and they used to trend beyond the extremes that we might think are the objective targets for that trend. Okay, so until we don't have enough evidence that we have a reversal in place, so the trend is still considered to be operative. The analyst should therefore also be careful when using price indicators as confirmation, may be more redundant than informative. Okay. So we'll see some examples in how to prevent that. Okay. So jumping from the definition to some guidelines to become a little bit more practical, I'm asked to raise my speaker's volume. I wonder if I can do it, but I can speak a bit louder, Mike. Okay. I'll try to speak a bit louder. Okay, on the guidelines about divergence. Divergence are mostly spotted with momentum indicators. Okay, also called oscillators. Okay, here we have a few of them: MACD, RSI, rate of change, momentum, stochastic, Williams percentage R, CCI, trend deviation, etc. Okay, maybe at this time we should see for a second what is momentum, to define some characteristics of momentum that will help us in spotting divergences, in understanding divergence a little bit deeper. The level of momentum informs about the direction and the quality of the trend. Okay. So in some cases, we can use momentum and momentum indicators as a mean to have the direction, the trend direction defined. Okay, it's not only that we use momentum or oscillators in ranging markets. That would be the most common rule when we hear about these kind of indicators, but the nature of momentum calculation also allows to spot direction. Okay, and obviously it allows also to verify the quality of the trend, and by quality we mean speed, we mean strength, and a few more characteristics that we shall see in a minute. Thus, a falling momentum does not imply falling prices. Okay, I think this is a basic idea, but should be mentioned, because what a momentum indicator does, it detrends price action, and it lets the price action oscillate above and below an equilibrium line, so to say. So by detrending the price action, it means that falling momentum does not imply falling prices. Okay, it's only really falling momentum with all that momentum means. So momentum indicators are very sensitive to changes in acceleration and velocity in the price. And acceleration and velocity are two of these characteristics that make momentum indicators so special. Here we have, for instance, an illustration with a car accelerating from 30 km to 60 km. So we have an acceleration and also an increase in velocity, but we may have a constant velocity. If the car, for instance, goes up to 60 km and sustains that velocity, we can still have an increase in price, and we can still sustain that direction. The car can still drive in the same direction, but there is no more acceleration, and the velocity has become a constant. The speed, in fact, in technical analysis, the speed is so to say the distance covered over time. Okay, it's a difference of we shall see in a moment examples of that, but it's the distance covered over time. Speed is also a more sensitive measurement than price level. Okay, you receive an earlier alert of a change in speed before you realize a change a sustained change in the price level. And acceleration, in turn, is more sensitive than speed. Okay, I have to accelerate first. The car has to accelerate first before it changes the speed. So the speed is also the measure of the price trends changing slope, so to say. Okay, for example, if a 5-day change in price is an increase of 100 pips, then momentum is simply 100, but the speed is 100 divided by 5, so 20 would be the speed. Okay, if prices continue higher at the same rate, the momentum, the speed, turns sideways, becomes a constant. Okay. And because of this sensitivity, of this high sensitivity, momentum indicators alert of a change in trend much before it happens in the price structure.